Okay, good. All right, so thank you very much. As Sophie mentioned, and I got the joke, wonderful. As Sophie mentioned, Brian Watson, Senior Vice President for Venbridge, which finances tax credits, CleanTech North, and a founding director of the Ontario Clean Technology Industry Association, and most recently, one of the members of the CPA Canada Working Group on the clean technology tax credits, which is award-winning. And my partner here up on stage, Martin, is also on. So Martin, introduce yourself.
Hi everyone, my name is Martin McLaughlin. I'm a partner in EY's business tax incentives practice. I focus largely around large capital projects, but also capital investments that relate to anything from capital cost allowance and these new investment tax credits. So happy to be here.
Wonderful. All right. So the last time we were on the stage for EC, last year at the ROM, we had a slide similar to this. Actually, I don't think we had the slide, but there certainly wasn't as much green on that slide. It was a lot more conjecture, not a lot of movement. So really happy to see that there is a lot more movement in the clean economy tax credits. That's the family of tax credits. There's 6 of them at current, 4 of which, if you'll see on the timeline, have actually now been legislated. As of June 28th, you'll see the CCUS, hydrogen, clean tech, and clean tech manufacturing tax credits have all been legislated and are technically claimable. We have guidance on all 4 of those. The following 2 clean electricity tax credits and EV supply chain are in different phases. We have draft legislation on one, nothing on the other particularly. But with the CRA guidance, we do have that for all 4 of the initial ones. We have NRCan guidance on at least, well, we have it on 4 of them, but the last documentation was the 2019 section 43.1, 43.2 guidelines. So I don't know about you, but there's been a little bit of technology development since 2019, so we're hoping to see those updated. And a big question is, from a lot of folks is, these are claimable, yes, but how? Because you'll see the endpoints on that graph, they're all red, except for the yellow. And even that's but possibly a little subject to change. We don't have forms. So, I guess we'll go into a few quick highlights on those. Sorry, we've covered the highlights and challenges. I guess the question for you, Martin, is, so we don't have forms, but we can claim these things. How the heck do we claim these things?
Yeah, that's a great question. So at the moment, the government has released some guidance around how to claim these investment tax credits. Largely at this point in time, the assets, first of all, have to be available for use. They have to be acquired and available for use after different time frames on there, and we can kind of walk through which. But let's say your asset is available for use with the exception of the carbon capture ITC, which is actually claimed when your costs are incurred. You would claim it along with your income tax return. Generally, that is claimed on the Schedule 31 for those who are familiar with the SR&ED tax credits and other types of investment tax credits that are available. So the guidance as of right now is on CRA's website. So they have a clean economy investment tax credit site, which has a lot of information, as Brian mentioned, around sort of what the ITCs are, what are the labor conditions, how to claim them. And they've kind of added some guidance in the absence of forms that in addition to filing with your Schedule 31, your income tax credit, you would also file some documentation that would support that. So the CCA class to which the assets relate, some of the supporting documentation, the capital costs of the property, etc. So it's all there for now, and hopefully we see those forms soon because we need them.
Yeah, I suspect telling people to fill in a box and save your homework doesn't necessarily give people a lot of confidence, knowing that they might face an audit and they might have to show their homework, and that might be varying different formats.
Yeah, I mean, that's a good point. I mean, regardless of when these forms come out, I would say save your homework. As Brian sort of mentioned, there's going to be an important sort of step after this. These credits are quite lucrative, so to the extent that you're making an investment that would be eligible for this clean technology investment tax credit or the clean technology manufacturing or any of the others, having that documentation is going to be key because CRA is likely going to come in and review these things. And so I would suggest that not only, do you submit what they ask for, but you maintain sort of the information that would sort of support the capital cost of the property and how it's eligible for the ITC.
And the labor conditions alongside that, if they're applicable to that particular tax credit.
Yeah.
Yeah, you mentioned one thing, and I promised we wouldn't go too deep and we'd keep this at Cole's notes level, but if possible, briefly mentioning, can you define available for use for folks? Because the question of when you can actually put these tax credits on your book is one that I get a lot of times.
Yeah, it's a tax term essentially. There's a couple things that kind of go into determining the available for use rules. I would say that generally speaking, it's when your asset is capable of doing what it's intended to do, but larger long-term projects also have some available for use rules, like the 2-year rolling start, which would allow you to claim depreciation earlier. And so these CCA classes will follow sort of those defined available for use rules. But in a general sense, I'll give you an example. You're installing a piece of equipment, you install that, you test it, you run it, it's able to do sort of what it's physically intended to do, like a manufacturing piece of equipment. It's capable of operating in the fashion that you need it to. That is available for use, and then you can claim it in that fiscal year. So let's imagine that you have, a piece of equipment that's going to be manufacturing, I don't know, heat pumps, for example. That piece of equipment, you tested it, commissioned it, and it's available today. And so you have a December fiscal year end, you would go in and you would claim the investment tax credit related to that piece of equipment on your December fiscal year end income tax return, which is due in June of 2025. And that's sort of how that would operate.
Great, thank you very much. So there's a lot to these tax credits. Are there any particular nuances, like the available for use, that you get asked about a lot? I get asked about leasing, and maybe that's one of them, but is there anything that you particularly get asked about all the time?
Yeah, there's a few actually. I think there's a fair bit of. We can touch on leasing. You want to touch on leasing?
Sure, let's go on
Let's
leasing
talk
first.
about leasing for a second. So I think there's questions out there around like, okay, so I'm leasing this property. Is it eligible? The truth is, no. You can't claim the ITC. You have to physically own the property. It has to be, yours. Claim it for capital cost allowance. However, if you are a business who is in the business of leasing that type of property and owning and leasing that type of property to third parties, and again, depending on the tax credit, that individual needs to be, a qualifying taxpayer. But there is an opportunity potentially to claim the investment tax credit if you are a company who owns that property and leases it to, say, Brian. Brian has to be a qualifying taxpayer, though.
Yeah, that's true.
Other questions that I often get asked, I think there's a fair bit of confusion around what is the difference between the clean electricity and the clean technology ITC. There's quite a bit of overlap there between the two. They have the same types of equipment that are eligible. So what is really the difference? One's 30%, one is 15%. What I would say is one of the differences is sort of the types of corporations that can claim. When it comes to the clean technology, you need to be a taxable Canadian corporation or a corporation that's a member of a partnership. REITs also qualify. But the other side of things is on the the clean electricity investment tax credit, is that's really geared towards taxable corporations, but also non-taxable. So, municipalities, corporations, publicly owned utilities, those types of things are also eligible for the clean electricity ITC. I tend to think of it as sort of clean electricity as being, bringing clean electricity either across provincial borders or larger projects, although there is no sort of size restriction on the clean technology. So I think the main difference is around the types of corporations that can claim.
Absolutely. On the non-taxable entity side, I've certainly seen a lot of interest from Indigenous corporations or partnerships involving Indigenous nations for everything from EV charging to generation. So that non-taxable entity, that's a bit of a shift from what the norm is in the past.
Yeah, absolutely. I'd say most tax credits that are out there, you need to be a taxable corporation or a member of a partnership taxable entity in a sense. So yeah, that is a shift. But I think if the intent is to sort of bring these things to a wider audience and make sure that we're able to decarbonize and meet Canada's ambitious goals of net zero by 2050, I think they need to open it up a little bit, and I think this is a great step.
Absolutely. So I get a lot of questions, and I've gotten a few from the audience already today, about my particular technology, it seems to fit the spirit of what these tax credits are, particularly in the clean technology or clean technology manufacturing realm. But the wording is a little obtuse. It doesn't quite fit. I've seen this with zero emission vehicles, but mine's a little bit of a hybrid and things like that. What advice would you give companies that are concerned that they might be on the border of whether the technology will be an eligible clean technology property, technical definition by CRA?
Yeah, that's a really great question. So as I mentioned sort of at the outset, I kind of skirted around the issue, but these investment tax credits really rely on capital cost allowance classifications. And so within sort of the Income Tax Act and within the legislation around the tax credits, they point to certain capital cost allowance classes, and it's not everything in these clean technology capital cost allowance classes that are eligible. So understanding sort of what the income tax regulations say around the CCA classes is going to be very important to sort of picking up the types of technologies. You touched on NRCan. NRCan has, depending on your property and depending on your project, has guidance that's out there. They have a guide to class 43.1 and 43.2, which is sort of those are just generally the clean technology classifications. If you're doing a CCUS project, there's a short 157-page document that outlines every single thing. So NRCan has really taken an active kind of role in these ITCs, and they've really outlined from an engineering and science perspective, like what fits in, what fits out, what's in the perimeter. So there's a lot out there.
NRCan has been extremely helpful in terms of helping define that and responding very quickly. All two of them that we know of. There's not, I'm a little worried about the bottleneck that could be there, but they definitely have been integral in terms of giving that sort of feedback and providing. I don't know that we've seen any opinions provided yet, but I suspect that mechanism will be used.
Yeah, and I think there's an interplay between CRA and NRCan in this case, but I think there's ruling interpretations that you can file for. But the other side of it is to sort of look at you can speak to advisors. You have advisors out there, everyone here, around sort of what you think is qualifying, and if you really do need to reach out to NRCan and get a ruling on a piece of technology, you could do that, because they guide around 43.1, 43.2, and the other side is CRA. They guide around the legislation with the tax credits. So I think that's a really good step to take.
Yeah, absolutely. Any other advice for companies? So I guess in most cases this would be adopters, aside from manufacturers or a clean tech company that might be adopting some other clean technology property. Any advice for the adoption and those companies that are applying for those tax credits? We have Save Your Homework, which my shred history loves hearing that. Yeah. But what else would you tell folks to do?
I think there's a perception out there that these are limited in scope and that they're limited to certain types of businesses who would be manufacturing clean technologies. Mm-hmm. And I think that the idea is they're trying to cover pretty much everyone who's in the clean tech space to a certain degree. Obviously, there's going to be these are legislated tax credits, and there's discretionary programs that sort of fill in the gaps for specific areas, discretionary like grants or loans. But I would say that understanding what's available, because it really does, like whether you're extracting critical minerals or processing those minerals or manufacturing component parts of clean technologies, or just you have an office building and you're putting in heat pumps, there's something there for most businesses. And I think that's important piece number one. I think the second piece is, I think there is the secondary perception is that when people do acquire property, there is that idea that the homework situation, like they don't think about what they need to keep in order to document this stuff. And because some of the labor conditions in a few of these requirements are quite onerous, I think planning in advance will do two things. One, it'll allow you to make sure that you optimize the investment tax credits that are available to you when you start to claim them. The second piece is that it will help you, determine whether or not your project is a viable project. These are going to drive down the cost of capital as you start to make these types of investments, and understanding what's available and how it stacks with other types of incentives that might be out there are going to be important as you undertake this project.
Talk to me about those labor requirements. They have some pretty stiff penalties. So they often get forgotten when people see the dollar signs of the tax credits, but the labor requirements are definitely there. What's the penalties on those?
We got 2 minutes and 26 seconds left. Can we get like another 20 minutes? No? Okay. So yeah, the labor requirements themselves, there's really two components. We sort of took this from the Inflation Reduction Act in the United States. First component is that you need to pay workers at a prevailing wage. So the individuals that they're really targeting are what they call covered workers, the folks that would be sort of really hands-on installing the equipment, testing the equipment, sort of journey people, tradespeople that would be involved in that type of project. So those individuals need to be paid in line with the collective bargaining agreement. To the extent that there isn't an agreement in place, you'd need to look to a comparable agreement. The secondary qualification is that there is an apprenticeship requirement, and within that apprenticeship requirement, you need to ensure that the folks that are working, let's say red steel trade individuals, have an apprentice working on site 10% of the time or more. There's a whole slew of other requirements that kind of go into, posting a sign at your site and making sure that you make reasonable efforts to get the highest apprenticeship levels possible. So they are quite onerous, which means that, going back to my earlier comment, planning this project out in advance is going to be key, because you don't want to miss those things, because it does change the credit from, let's say, a 30% credit to a 20% credit, or in the clean electricity space from a 15% credit to a 5% credit.
Absolutely. So big penalties if you don't have the compliance, and save your homework to prove that you were compliant, including posting your signs, which is actually in the legislation. So there's definitely, and I think that piece of legislation is about 100. It's pretty meaty too. It's lengthy. So just quick Coles Notes run down. We have legislation. We have 4 tax credits that are claimable. The process is being worked on right now, but you can submit if you're a December 31st year end. You can submit for the CCUS, Cleantech, manufacturing, and hydrogen tax credits for work that you did this year and assets that you brought online. You pushed the button, the battery was charging, and taking the load off your fridges for your meat and cheese. If that's all working, you can claim those this year. So absolutely, there's some some kinks that need to be worked out. But these are working, and I'm hoping that next year that timeline has a bunch of dollar signs as to what money has actually been deployed and how many GHGs have been mitigated by the deployment of these clean technologies. So, Martin, thank you so much for joining me again on stage, and
Anytime.
I look forward to next year as well.
Thanks, everyone.
Cheers.